Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
So we are looking at a monumental shift happening halfway across the world right now,
Right.
but it's one that is absolutely going to directly impact your portfolio as an American investor.
Oh, without a doubt.
I want you to just imagine the world's biggest, most reliable ATM. For decades, this ATM has been spitting out cash, funding businesses, real estate, government debt all over the globe.
Yeah, a massive liquidity engine.
Exactly. Now imagine walking up to that ATM, you put in your card, and you see a message that says, sorry, funds are being kept at home.
That is a terrifying message for the global market.
Right. And that ATM is Japan. For a really long time, Japan has been sitting on this mountain of overseas cash.
Yeah.
But based on recent data we've been looking at, they are desperately trying to figure out how to bring all that money back within their own borders.
Yeah, and the scale of this wealth is, it's honestly difficult to overstate.
How big are we talking?
Well, according to recent analysis from July 2026, Japan is the world's third largest net creditor.
Wow. Third largest.
Yeah. If we look at the numbers from late 2025, they were holding roughly $3.5 trillion in foreign assets.
3.5 trillion.
Trillion with a T. That is capital they have just, injected into the global system over years.
Right.
But we are looking at a situation today where their domestic economy, specifically their currency, is under immense strain.
So the mission for today's deep dive is to explore the mechanics of how Japan is trying to entice its citizens and its massive pension funds to invest in their own country rather than abroad.
Exactly.
And most importantly, we really need to connect the dots on what this means for the global economy and for you as an investor, especially right now.
Right, because to understand the solution, we have to deeply understand the problem they're facing.
Yeah, like why the sudden urgency to bring the money home?
Well, the data shows the Japanese yen has recently been hovering around 161 to 162 against the U.S. dollar.
And just for some historical context for the listener, that places the yen at nearly 40-year lows.
Which is brutal.
Yeah, we need to talk about why a weak currency is just an absolute nightmare for Japan specifically.
Right, because they are an island nation.
Exactly. They don't have massive domestic oil fields or, endless agricultural plains.
No, they have to import almost all of their energy.
And a staggering amount of the raw materials they use to manufacture goods.
Which means the exchange rate basically dictates their basic survival costs.
Right.
Let's break down the mechanics of why the yen is so weak right now, because it doesn't just happen by accident,
It's the interest rates, right?
Exactly. It all comes down to the interest rate gap between Japan and the rest of the world, particularly the United States.
Because money is highly logical. It flows to wherever it gets treated bad.
Precisely. If you can earn a 4 or 5% risk-free return holding U.S. dollars, but you earn practically zero holding Japanese yen.
If you're going to sell the yen.
Right. Investors will naturally sell their yen and buy dollars. And that massive selling pressure drives the value of the yen straight down.
And when the yen goes down, the price of literally everything Japan needs to buy from the outside world goes up.
Right.
Like if oil is priced in U.S. dollars and your yen is suddenly worth drastically less, filling up a gas tank or powering a factory becomes incredibly expensive for everyday Japanese citizens.
Yeah, it creates a severe cost of living crisis.
Yeah.
But what turns this from a difficult situation into a true financial emergency is that this currency weakness is colliding with a massive structural breakdown in their bond market.
Okay, unpack that for us.
So for decades, the Bank of Japan, which is their central bank, similar to the Federal Reserve in the U.S., they've been the ultimate guaranteed buyer of Japanese government bonds.
JGBs.
Right, JGBs. They effectively printed money to buy their own national debt, which artificially suppressed interest rates, keeping them at rock bottom.
Because if the central bank is always standing there with an open wallet, like willing to buy every bond the government issues at a high price,
The yield stays low.
right, the yield or the interest rate those bonds paid, it stays incredibly low.
Exactly. But the data shows the Bank of Japan is now slowing down its purchases of these bonds.
They're pulling back.
They're stepping away from the market, which opens up this terrifying gap. If the central bank isn't printing money to buy the debt anymore, who on earth is going to buy it?
And that is the multi-trillion-dollar question currently keeping policymakers awake at night.
It really is. Because when the guaranteed buyer leaves the room, the market has to find a natural price.
And that gets messy.
Very. In early July of this year, because it wasn't clear who the new buyers would be, The Japanese bond market experienced severe stress. We saw bond yields spike dramatically.
Like how high?
The yield on 20-year government bonds hit 3.890%, and 40-year bonds hit 4.055%.
Okay, we should pause and really put those numbers into perspective.
Yeah, definitely.
Because 3.8 or 4% might not sound high to an American listener used to our current mortgage rates.
Right, sounds normal to us.
But for a country that has literally had interest rates near zero, and sometimes below zero for years, a jump to 4% is a seismic event.
It's an earthquake. Higher yields mean the Japanese government suddenly has to pay a much heavier financial burden just to cover the interest on its national debt.
Which creates a pretty devastating feedback loop, doesn't it?
Oh, absolutely. The government has to spend more of its budget just servicing debt, which leaves less money for the actual economy, which further weakens the country's financial standing.
You know, it makes me think of an analogy. Imagine you own a bakery here in the U.S.
Okay, I'm with you.
You've invested all your family's savings into a really great global stock portfolio. It's doing well. But suddenly, the cost of flour and eggs skyrockets and your bakery's roof starts leaking.
Bad combo.
Right? You look at your global portfolio and realize, well, I need to bring some of that cash back home to fix my own business.
That's a great way to look at it. The leaking roof in this scenario is the combination of a weak yen and spiking government borrowing costs.
Right.
The government desperately needs a new buyer for its bonds to keep those yields from spiraling completely out of control.
And since they can't rely on the central bank's printing press as heavily as before, they are looking inward.
Exactly. The strategy relies on tapping into the vast pools of domestic wealth held by their own citizens and their national retirement funds.
I've actually been calling this the piggy bank strategy in my own notes.
I like that. It fits perfectly.
Yeah, because based on the research, Japan's finance minister, Satsuki Katayama, recently signaled that the government pension investment fund, the GPIF,
Have a massive fund.
right, that they should be encouraged to invest significantly more in domestic Japanese financial assets.
And we aren't just talking about a standard retirement account here,
Yeah.
The GPIF is one of the largest single pools of investment capital on the entire planet.
So moving that money is a big deal.
It operates on a scale that actually moves global markets. Directing a fund of that magnitude to pivot away from foreign assets and focus back on Japanese soil is, well, it's a monumental policy shift.
But the strategy doesn't stop at the institutional level, does it?
No, not at all. The government is also looking at the retail level, the everyday citizen. They are actively considering allowing Japanese government bonds to be included in NISA accounts.
Okay, let's define NISA for the listener, because it's crucial here.
Good idea.
A NISA account is essentially the Japanese equivalent of an American Roth IRA. It is a personal tax-free investment account created by the government to help everyday citizens build long-term wealth.
Right.
But this is where the logic seems completely backwards to me. Wasn't the entire original purpose of the NISA program to get Japanese citizens to stop hoarding cash and start buying riskier assets like stocks?
Yes. You are hitting on one of the most fascinating contradictions in modern economic policy.
Okay, glad I'm not crazy.
No, you're spot on. Historically, Japanese savers were famous for keeping their money under the mattress, so to speak.
Because of deflation, right.
Exactly.
We should explain that mechanism, because it's so alien to anyone who has only lived through inflation here in the U.S.
Yeah, it's totally backwards.
If you are a consumer living in a deflationary economy where prices are constantly dropping, you look at a new refrigerator and think, why would I buy this today for $1,000 when it will probably cost $900 next month?
Right. You are financially incentivized to hold on to your cash because your money actually gains purchasing power just by sitting there.
Exactly. But when everyone stops spending and stops investing, the entire economy grinds to a halt.
Which is what happened in Japan for decades.
Right. So the NISA program was designed to break that psychology. It was supposed to push citizens out of cash and into the stock market to stimulate growth.
Yep.
So turning around and telling them to use those tax-free accounts to buy boring, low-yielding government bonds. I mean, isn't that a massive U-turn?
A U-turn is the perfect way to describe it. The government spent years trying to push citizens out onto the risk curve, and now they are actively trying to pull them back into the safety of sovereign debt.
Oh.
It really highlights just how desperate the need for domestic bond buyers has become. The government is attempting to transform everyday household savings into a captive domestic safety net to absorb the national debt.
And the market reaction to this U-turn was incredible to watch.
Oh, totally wild.
The data shows that immediately after these policy suggestions were announced on July 10th and 14th, the bond market took a massive collective sigh of relief.
Right.
The yield on a 20-year bond plummeted by 17 basis points, down to 3.580%, and eventually settled around 3.53%.
We should probably unpack what 17 basis points actually means in this context, because to the average person, it sounds like pocket change.
Yeah, fair point.
A basis point is 1/100th of a percentage point, so 17 basis points is a drop of 0.17%.
Which doesn't sound like a lot.
In the retail banking world, it's nothing. But in the sovereign bond market, where trillions of dollars are traded and risk is measured in fractions of a fraction, a 17 basis point drop in a matter of days is a violent, massive swing.
It's huge.
It indicates a huge wave of buying pressure, because when people buy bonds, the price goes up and the interest rate goes down.
And the currency markets reacted too, right? The yen got a quick boost off the back of these announcements.
Yeah, it did.
It seems like just the psychological signaling from the government, like the mere suggestion that they were going to start aggressively buying their own assets, was enough to cool down the panic.
Psychology plays a massive role in financial markets. The government managed to talk the yields down from their peak without actually having to spend a single yen, simply by indicating a change in future policy.
But whenever markets react that violently to psychological signaling, the rumor mill just goes into overdrive.
Oh, inevitably.
And the immediate narrative that took hold online was that Japan was gearing up for a global fire sale.
Right, the panic selling rumors.
Yeah. The rumor was that the GPIF and other Japanese institutions were going to wake up tomorrow, instantly sell off all their American stocks, dump all their European government bonds, and repatriate trillions of dollars overnight to save the yen. We really have to look at the data and clear up this misconception, because it's causing a lot of unnecessary panic.
Yeah, the data strongly refutes the idea of an overnight fire sale. A massive, sudden dump of foreign assets is highly unlikely for several structural and legal reasons.
Okay, let's break those down.
Let's start with the GPIF. The finance minister cannot simply treat this pension fund as a personal piggy bank to solve a short-term currency crisis.
Because it's not their money, technically.
Exactly. By law, the GPIF operates with an independent mandate. Its sole legal fiduciary duty is to generate returns for the pensioners, the citizens relying on that money for retirement.
Right.
Any structural changes to their investment allocations require rigorous review, modeling, and broad consensus.
You know, it's helpful to think of the GPIF not as a sports car that can do a handbrake turn, but as a massive ocean-faring cargo ship.
I love that.
Yeah, like when a cargo ship that size needs to change direction, the captain doesn't just spin the steering wheel and instantly face the opposite way.
If they tried that, the ship would capsize.
Exactly, which in this case means crashing the global financial markets. Instead, the captain makes a slight adjustment to the rudder, and it takes miles and miles of open ocean for the ship to slowly carve a new path.
And the historical precedent supports that cargo ship analogy perfectly.
How so?
Well, if we look back to 2014, Japan initiated a sweeping set of economic policies known as Abenomics, named after the late Prime Minister Shinzo Abe.
Right, the three eras.
Exactly. The goal of Abenomics was to finally break the back of that deflationary trap you mentioned earlier through massive monetary easing and structural reform.
Yeah.
As part of that initiative, the GPIF made a major shift in its portfolio allocation to take on more risk. But that transition didn't happen on a random Tuesday. It took the fund 2 full years to execute the shift and fully adjust their allocations.
And looking forward, the research points out that the GPIF's next scheduled strategic portfolio review isn't even happening until 2030.
Exactly.
So we are not looking at an imminent catastrophic dump of foreign assets. But let's say they do decide to move, $80 billion out of foreign bonds and into domestic Japanese bonds. How does that actually happen in practice, if not through a fire sale?
It happens through a process of natural attrition and reinvestment.
Okay, explain that.
Let's say the GPIF holds a massive portfolio of U.S. Treasury bonds. Every month, some of those bonds mature, meaning the U.S. government pays back the original loan amount in cash.
Right, the term is up.
Historically, the GPIF would take that cash and immediately buy new U.S. Treasury bonds, recycling the capital back into the American system.
Got it. So what changes?
Under a new domestic focus, they simply stop the recycling. They let the foreign bonds mature, they collect the cash, and instead of buying new U.S. debt, they use that cash to buy Japanese government bonds.
Yeah.
It is a slow, methodical redirection of cash flow.
That makes perfect sense. They aren't breaking the dam. They're just slowly digging a new trench to redirect the river.
Precisely.
But this brings us to the most important part of the conversation. If this is just a slow, gradual, highly regulated shift happening inside Japan over the next several years, why should an American investor, perhaps someone just starting to build their portfolio, care about this at all?
Because we are watching a fundamental shift in Japan's identity on the global financial stage.
In what way?
For the better part of the last 40 years, Japan has been the ultimate exporter of capital. Because
Okay.
their citizens saved so much and their domestic interest rates were so low, they took their surplus wealth and sent it abroad.
Right, chasing yield.
Exactly. They bought American real estate, European equities, and, most importantly, massive quantities of U.S. government debt. Now, they are shifting their identity to become an absorber of their own capital.
Which has massive implications. If Japanese pension funds and everyday citizens using their NISA accounts start heavily favoring domestic stocks and bonds, it creates a brand new captive audience for Japanese assets.
It really does.
Suddenly, Japanese corporations and infrastructure projects have a massive new pool of domestic funding to draw from. It's like keeping the neighborhood's wealth circulating within the neighborhood.
It could be incredibly beneficial for the internal stability of the Japanese economy, but the ripple effect for the rest of the world is where it gets complicated.
Right, because if Japan is historically one of the biggest, most reliable buyers of U.S. and European debt,
Yeah.
and now they decide to keep their capital at home to buy their own Japanese bonds, doesn't that mean there's one less massive customer showing up to the global bond auction?
Exactly the point. Over the next 6 to 18 months, this slow, steady reinvestment away from foreign bonds creates a gradual but highly noticeable reduction in global demand for U.S. long-term bonds.
And that affects us here at home.
Definitely. As an American investor, you have to look at the broader landscape. Under the current Trump administration, the U.S. is, actively issuing significant amounts of debt to manage domestic growth and fund government operations.
We rely on global demand to absorb those bonds.
Yes, we do.
And the basic laws of supply and demand tell us exactly what happens next. If the U.S. is supplying a massive amount of bonds, but a major buyer like Japan is demanding fewer of them, the price of those bonds drops.
Right.
And as we established earlier, when bond prices drop, yields go up.
Exactly. The U.S. Treasury has to offer a higher interest rate to attract whatever buyers are left in the market.
So Japan deciding to fix its own leaky roof by keeping its money at home could subtly but persistently put upward pressure on long-term interest rates right here in the U.S.
The interconnectedness of global finance means that a policy shift in Tokyo eventually shows up in the mortgage rates, the corporate borrowing costs, and the equity valuations in New York and Middle America.
It is wild to think that a Japanese pension fund deciding to buy local bonds could make it slightly more expensive for an American to get a car loan.
It is, but that's the reality of a globalized economy.
But there is a glaring catch to this whole strategy for Japan, isn't there?
Oh, absolutely.
The government can promote NISA accounts and encourage the GPIF all day long, but shuffling domestic money around doesn't actually fix the root problem of the weak currency, not unless they change the underlying mathematical reality.
The data is very clear on this limitation. Policy rhetoric and tax-free accounts are essentially bandages over a much deeper wound.
Right.
For the Japanese yen to experience permanent, sustainable strengthening, the Bank of Japan must prove to the global financial markets that it operates with true independence from political pressure.
They have to prove they're willing to administer the tough medicine. And the tough medicine is raising interest rates. Because right now, the gap is just too wide. As long as U.S. interest rates remain relatively high to combat inflation and Japanese rates remain near the floor, the math dictates that the yen stays weak.
Investors will continue to move their capital across the Pacific to capture those higher yields.
Exactly.
The market is demanding real, decisive action. If the Bank of Japan bows to pressure from the government, who naturally want to keep rates low so they don't have to pay higher interest on the national debt, the yen will continue to struggle.
Right.
But if the central bank acts independently and actually raises rates, closing that yield gap with the United States, then you alter the fundamental flow of capital.
Makes sense.
The domestic buying strategies like NISA and the GPI shift are helpful supplementary tools, but they are entirely secondary to actual concrete monetary policy from the central bank.
So bringing it all together, what does this ultimately mean for you, the listener? It means we have a front row seat to watch an economic giant wake up to a harsh reality.
It's historic.
Yeah. Japan is realizing that it needs to feed and stabilize itself before it can continue funding the rest of the world. And observing how they execute that pivot is one of the most fascinating economic events of our time.
It really forces us to confront a reality we haven't had to face in decades. It leaves us with a profound question regarding the architecture of the global economy.
Was that?
Well, for a generation, Japan has been the reliable, wealthy neighbor, sending its surplus capital overseas, acting as the bedrock for global growth and liquidity.
The ATM we talked about.
Exactly. As they inevitably shift toward keeping their wealth inside their own borders to stabilize their own foundation, we have to ask what happens to the global financial ecosystem when its biggest, most consistent financial donor finally decides to close its wallet and focus strictly on its own backyard.
It is an incredibly complex puzzle, and it is definitely something to think about the next time you look at the trajectory of global interest rates or the currency markets. Don't forget to subscribe and hit that like button.